David Long, let me begin with you. We heard Wolf just talking about Wells Fargo. I know you have a sell on it. I would assume there's nothing you saw, at least, from the quarter thus far that gives you any pause in terms of that rating.
No, not at this point. My biggest concern is the pre-tax, pre-provision income the company reported. We were looking for $5 billion in pre-tax, pre-provision income. They came in at about 3.4. And factoring out some of the noise with the excessive operating loss against some of the excessive operating gains, you're still at about $4 billion in pre-tax, pre-provision income. That's 20% below our forecast and the street forecast. And when we look out going forward 2 years, we were already projecting a 27% decline in pre-tax, pre-provision income between 2019 and 2021. And again, that excludes the impact of reserve losses and reserve building. So from a fundamental basis and a core earnings power basis, the numbers were worse than expected, and that does not bode well for our estimates going forward.
Yeah. David Conrad, let me come to you. Of J.P. Morgan and Citi and Wells, which quarter impressed you the most, and is the market getting it right today?
I'm a little surprised that Citi's a little bit weak. Not surprised by Wells Fargo's decline, but J.P. Morgan was certainly the strongest quarter. I think if you take a step back with the universal banks, the Fed has put up so much liquidity. As you know, they've been engaged in buying corporate bonds. That's created this backdrop for huge capital markets. I don't think it's sustainable, but I think effectively the Fed's policies has been a capital raise for the universal banks. And so what you saw from both Citi and J.P. Morgan is plowing that back into the reserves, in many ways ring-fencing some of the riskier loans. J.P. Morgan now is 3.4% reserves. Importantly, it's almost 13% reserve against cards. The total loss rate, I think, was 16% in the severe adverse stress test most recently. So I don't think there's a lot of reserve build there. And so, I do expect, as Jamie said on the call, trading will be cut in half probably next quarter. IB will be down year over year. That's pretty much in line with expectations, but I don't think we'll have to build the reserve next quarter, so that'll be a lift to numbers.
I'm loving this whole it's like David cubed, this panel. But David Long, I want to go back to this loan loss reserve piece of this, and the fact that we did get some comments that Wilfred just reported on about the fact that if it weren't for stimulus, things would actually probably be a lot worse. When you're talking about actual defaults, whether it's consumers or companies, and this idea of maybe having those forestalled or curtailed by government stimulus and these forbearance programs that are in place right now, I think it really raises the question, are we going to see a reduction in defaults or just a delay in defaults? And how do you game that out as you look at some of these names, some of these stocks into the second half of the year?
Sure. The loan deferrals that the banks have offered, combined with the stimulus from D.C. and then the moves by the Federal Reserve, have definitely pushed off the time of recognition of more losses and really loans moving into the non-accrual status. So we don't expect loans to really start to go bad until the fourth quarter. That's when we think the rubber will hit the road. And we don't think losses will peak into the second quarter of next year. And because of all the stimulus and the deferrals, we just don't know at this point what the level of losses are going to be. So yes, Wells built the reserves to 2% of total loans. But look, they still have exposure to retail, 5% of loans, credit cards, 4%. Energy, hotels, entertainment, 4%, office buildings, 4%. So there's a lot of exposures out there we're just uncertain about. So I think that creates volatility not only for Wells, but for the rest of the banking industry until we really know what the ultimate level of losses will be.
And David Conrad, let me just conclude with you. I mean, I'd imagine it's not the greatest time to be a bank analyst when your group is sort of out of favor the way it seems to be in this market. What's it going to take for that to really change?
Yeah, I think a couple of things. One is obviously more certainty around the dividend. I thought Jamie was pretty confident on the JPM call about the dividend, where it is and where the capital is. But of course, a severe W-shaped economy puts that at risk. And so I think getting through the next few quarters with better visibility of the dividend, and I think as David Long said, looking at 1Q, 2Q of next year, kind of peaking credit costs, I think the market wants to see not only provisions coming way down, which I think we'll see that, but I think it'll be tough for the banks to work with net charge-offs still ramping up. We want to see that delta come down as well. So I think the big all clear sign will be more mid next year.